Hello and welcome to today's video. In this video, we'll try and understand the efficient market hypothesis, which tells us that the price of an investment asset takes into consideration every information that is available in the market. The price has already considered all the available information that you can possibly think of if it's available in the market. If this is true, then any analysis that you do for a stock, for any security, is irrelevant. Surprised? Little tricky, isn't it? Stay tuned, we'll see all of it right here. Placing a trade at 9:15. Wow, this is a good one. I see a strong push. 10 o'clock, it's a profit. I'm coming out. Done. 11 a.m. Good one to short. Done. 12 came out. Wow, profit. 12 noon, getting in again. It's a huge pressure. Wow. Placing orders again at 3. Done. Whew. Profits for the day. Covered. See, whether you're into daily trading or investing, whether you do a technical analysis or a fundamental analysis, no one can beat the market in the long run. That is the core of EMH, the efficient market hypothesis. So EMH, one of the primary justification for some investors who go for the passive way of investing is because of the efficient market hypothesis. It helps in providing justification for investments in mutual funds and ETFs. According to the EMH, the investors should be logical. Each investor will behave arbitrarily. However, if you see an overall performance, the market is always correct. Well, if I have to give you an example, in a panic market, you see many investors would sell off their securities and come out of the market to prevent further losses in their portfolio. This is the herd mentality. When everyone is selling off, it also forces you to sell off. Many panic and go with the crowd and sell off. And it looks normal at times. But the question is it a rational decision? Now, suppose you consider what EMH says, that all possible information is already included in the price, is already accounted for in the price. Now, under this hypothesis, the fundamental analysis can provide you with returns which is over the average returns that this market can provide you in a shorter period of time. Now, but since there are no patterns, the fundamental analysis does not provide a long-term advantage. And of course, technical analysis doesn't work at all. So, this hypothesis is weak. Now, if you have to counter this question, you would say probably neither fundamental analysis nor technical analysis is foolproof. Neither of them provides you with an advantage. Now, for this hypothesis, new information feeds into the price for the security. Makes sense now. Now it looks better than the previously discussed a weak hypothesis. So let's take it as a semi-strong hypothesis. This looks good. Now let's take into consideration all the factors, all the available information from the past, present, and probable information that are going to come into future into the price consideration of the security. If that be it, no investor can probably gain from investing in a security in the market, because anything that has happened or is happening or will happen in future is already considered into the price. So there will not be any movement, there will not be any profits or any loss bookings. You cannot gain from the market at all. A very strong hypothesis. But if you follow this, you'll have to hunt for the outliers to gain something, the little bit that is there in the market which it has to offer you. Now, the EMH and the investing strategies, what and how you should follow it. For those investors who believe in the EMH, who believe in this hypothesis, even if it's the weakest form, they tend to invest in ETFs and mutual funds or index funds and so on and so forth. These are safe. They don't attempt to beat the market. They just simply match the market performances. Rather, mostly the index funds and the ETFs, they match the market performances. Some investors, however, believe that there is an opportunity to beat the market. There are investment opportunities that has the potential to beat the market, and they can capture them. It can be predicted. Now, for investors like these, the short-term strategy works. They study the short-term movement, the short-term buying and selling pressure, the patterns in the market or in a security. So people like these who do a daily trading, they'll simply outright reject the EMH, because for him, the hypothesis does not help him in his daily trading strategy. So the bottom line is, it's a hypothesis. Whether you believe it or not, it's all up to you. If you feel you cannot predict the market, you believe you are a believer of the EMH. And if you can predict the market, like one of those successful day traders who believe that market movements can be predicted, you would probably reject the hypothesis and say, no, that is wrong. EMH is wrong. I can predict the market. I can beat the market. I can get returns out of this market. I can get returns from the price fluctuations that are in the market, which were not considered into the price of the security as per the EMH. So if you want to take a safe flight, be on the safe grounds, believe the EMH and invest passively in index funds. That's it. Vice versa, if you believe that you can capture the movement of the market, if you believe that you can study the market movements, market notion, the buying pressure, the sell pressure, all these things are good for you. You can handle this, you can handle the daily fluctuation, the daily pressure. Go ahead. The market is for you. The EMH, however, is not for you. This hypothesis is not for you. That's all for today. Happy investing. Stay tuned, like and subscribe this channel, and we'll bring you more of the mindset, the concepts about investing and how you can handle and tackle it to be a well-informed trader or an investor. Till then, SG signing off. Goodbye.